The broadcast is now starting. All attendees are in listen-only mode.
Hi, everybody. This is AJ Brown with Trading Trainer. If you can hear my voice, please raise your virtual hand. Welcome, welcome. If you take a look at your webinar software, I know that we've got folks on board right now with our webinar tonight that perhaps have never been part of one of our Trading Trainer webinars. We asked everybody that we knew to be part of this evening's webinar. So take a quick moment and look in the upper right-hand corner where you're probably seeing your webinar software, and you'll probably find an orange button with a white arrow. I recommend you click that button. That button will minimize the major portion of the webinar software so that it is off your screen and not taking up valuable screen real estate. The other thing I would do is one of the buttons that remains on that little compacted view of the webinar software is a view in full screen button. And I would press that so that the screen that I'm not sharing yet, in other words, the screen I'm sharing right now is the welcome screen. It has our Ask AJ Brown logo at the top and a little picture of me right there. That should be showing in your full screen. Tonight we'll be using some charts and some graphs and some different ways to answer some of the questions you typed in. So I want to make sure you're not having to squint at a small screen within a screen. So let's watch this webinar in full screen. And finally, you have your hand raising button. So I'd like you to be able to interact with me. So if you can, find that hand raising button. It's at the bottom below that orange button with the white arrow. And click it now just to make sure that you know how to raise your hand. Excellent. I'm seeing a whole bunch of your hands go up. And click it again, and that'll put your hand back down. Excellent. Perfect. All right, so let's go ahead and begin. I'm going to share my screen here. In a moment, I guess, as soon as I can. There we go. And the way that we did this call is we put it out, like I said, to the world, if you will, everybody that we knew, and said, come on this webinar. The only cost of admission is for you to ask a question, your most hot burning question, and I'll do my best to answer it. Well, we got close to 200 questions in just the last 48 hours that we've been advertising this particular webinar. And I do plan to do this webinar often. Right now on the schedule, we will be doing this webinar monthly. And so what I did was I took all of the questions that you asked and I put them through some software that helped me figure out what the most commonly asked questions were. And I'm just going to hit those. And then next month when we do this again, We'll see if the questions that come up are different, and I won't answer the same question twice unless, of course, it's warranted because of a change in the environment. But in the meantime, let's just start fresh tonight. And some of the biggest questions were, what sort of option trading strategy should I be trading given the market today? So to answer that question, I'm going to kind of give you an idea because I want you to be armed with how to determine what strategy to use whenever, okay? And in order to do that, you have to do something called a broad market analysis. Now, I do a broad market analysis every time the market session ends. So the markets, at least here in the States, are open from 9:30 in the morning to 4 p.m. in the afternoon, Eastern time, New York City time. And so any time after that, 4 p.m. in the afternoon, all the way back up to 9:30 the next morning, you can do your broad market analysis. It's important to do the broad market analysis not during live trading sessions. And of course, the broad market analysis I do over the weekend, that I do every month, and that I do every quarter is more involved than the one I do daily. By the way, the weekly broad market analysis that I do is pretty straightforward. You do that on a Saturday or Sunday. When do you think I do my monthly broad market analysis? Think it through. You might have an answer off the top of your head. It's not the first of the month or the last day of the month. It's after the third Friday of the month. Does that make sense why? If you like that idea, raise your hand. All right, so people are raising their hands. The third Friday of the month, of course, is when monthly options expire. Monthly options have the most liquidity. Monthly options are a good place to spend a lot of your analysis time, and then if you want to bounce from those to weeklies, go like that. So with that said, I do my monthly analysis the weekend after the third Friday of the month. And then my quarterly analysis happens, when do you think? I like to do my quarterly analysis right after every earnings season. Right after every earnings season. Okay. So let's talk about what we want to accomplish with this broad market analysis. Basically, we want to understand what's the broad market up to. And the broad market is going to tell us what sort of option trading strategies we should be looking at that moment. On a tangent, I'm a fan of learning something called pattern recognition first, and then pattern utilization second. So those two words or two labels you may want to write down. Pattern recognition followed by pattern utilization. And this doesn't just go with trading, this goes with just about anything. Before you try to profit in any way off of any situation, it's very important that you sit down and you really understand what the heck the situation is. And in trading or in investing, that is paramount. So why I make a big point of this is, especially in the questions that quite a few of you asked, you were asking, what option trading strategy should I use right now? So you're jumping towards asking me what pattern utilization method works. And my answer is you've got it backwards. You should be asking, what pattern are we seeing? I want you to, here's another label I'd like you to internalize, and that is, I'd like you to strive to be a pattern recognition specialist. That's where, as investors, as traders, we should all start, is being able to recognize patterns. Once you are a pattern recognition specialist, the next step is to become a pattern utilization expert. Pattern recognition specialist, and then a pattern utilization expert. Okay. So back to the main topic, a broad market analysis will allow us to understand the patterns that we're seeing in the broad market, and those patterns will dictate what option trading strategies are going to work at that moment. Think of your option trading strategies, whether they be the family of premium selling strategies, which include covered calls, covered puts, diagonal debit spreads, diagonal credit spreads, vertical spreads, condors, even half condors, or otherwise known as credit spreads. All of those premium selling strategies and all of the directional trading strategies, whether it be a simple stock replacement strategy or whether it be something like selling the premium based on directional or buying the premium based on directional, using debit spreads or vertical spreads in the analog, all of those directional strategies. And then there's plenty of strategies where we profit on implied volatilities changing. They're all tools in your trader's toolbox, and they all have a different purpose. And as long as you match the right tool with the right situation, you have the highest probability for success. And again, these are all straightforward analogies. If you ask any handyman, what happens, for instance, if he tries to use a hammer where he needs to be using a wrench? Well, he's going to probably wind up dinging up the materials, taking a lot more time than usual to get the job done, and possibly not even getting the job done. Even worse, probably destroying some materials rather than just accomplishing the same task. If you have the right tool for the job, you're going to up your chances for success across the board. So think of the option trading strategies as your tools. Your pattern recognition is where you're going to identify what's the situation you're in, what materials are you working with, what do you have laid out in front of you. And from that, you'll be able to determine then which tool to use, what works at that time. So pattern utilization starts at the broad market level. I'm going to go ahead, just for laughs and giggles. I know a lot of you are not program participants of any of my programs. You're just here visiting. But I am going to log into the Trading Trainer Learning Community web portal, because we have some tools in there that'll help me explain what I'm talking about. So I'm going to visit the tradingtrainer.com website at tradingtrainer.com. And I'm going to go to where it says login, which will bring us to where our program participants are given a username and password. And I'm going to use mine. And I'm going to log in. In our web portal, I'm going to use one of my trading tools called the charting. Now, of course, you can recreate this in any charting tool that you have. When I do a broad market analysis, the first thing I take a look at, just using a standard price chart, is the Dow, the NASDAQ, and the S&P 500 index. So that's what I'm going to recommend that you do as well. And you can use whatever tools you have in your tool build for helping you get an idea of what the broad market is doing. But start there. Look at those big three indexes. If you want to include one of the sub-indexes, add the Russell 2000. But what we want to do is get an idea using our patterns in price, using our volumes. We want to get an idea of where levels of resistance and support are, whether we're consolidating, whether we're trending, whether we have found a top or a bottom. So as you can see here, the industrials, ever since the Federal Reserve announced that it wasn't going to do as many rate hikes as the market would have liked, has been selling off. But the question is before the Federal Reserve meeting, was there any hints that the pattern was going to break like this? How many of you with a show of hands say yes, there were hints? Just looking at this chart that I've got on the screen. Yeah, we had 2 weeks of hints. If you take a look over here, whenever you see price action consolidating, it's almost like you're watching a pressure cooker fill with pressure. That's the Dow. Here's the NASDAQ. Similar. And then the S&P 500, which I feel like is the index that most represents the underlying symbols and option chains that I trade. So getting an idea of the overall broad market, here's the next step. The next step is I like to compare sectors to the broad market. One of the ways to do that is to simply pull up your sector indexes and plot them on the same graph as a line chart for your S&P 500. So for instance, in our software, and you, again, everybody's got access to different charting packages. But we actually have our sectors just available to us, which makes it a little bit easier. We'll pull up our charts, and you can just go down the list of the sectors and see how they compare to the broad market. Why? Because we're looking for any sectors that are actually following the broad market, and we're looking for any sort of sectors that may be marching to the beat of their own drum. And you just want to scroll through these things. You just want to do for yourself a visual comparison and highlight any of those that might be out of the ordinary. So I might put into, and most charting packages allow you to do this. I'm going to go ahead and plot a secondary index like the S&P 500. And you'll notice you'll want to, if you're looking for patterns, you'll want to make sure that you're using two different scales in your charting package so that you can overlay them just to see the price action, because they may not be at the same dollar figure. I'm going to go ahead. One of the things I like to do is I like to change the colors that I'm looking at so that I can see them from a mile away. I like to make them bold, as you can see I'm doing here, and I like to make them contrasting, because I'm simply going to click through these things just to see if there's any sort of one that sticks out. Now, what I'm looking at right now is the Dow versus the S&P 500. The Dow and the S&P 500 look pretty close. How many of you with a show of hands would agree? That's not always the case. But now let's go into some of our subsector and sector. So here's aeronauticals. Similar, right, to the S&P 500. Here's agriculture. Similar, but seems to have not had such as strong a bull run in the last couple of months, but still a similar pattern. And you can just, in our charting software, and just about every charting software that I've come across, you can just click through using your keyboard and you can find which one of these things doesn't match. So far, a lot of them have matched in pattern. This one right here, DJUSAS, I'd have to look up what sector that is, seems to have been going sideways this whole time while the rest of the market's been going up. That might be worth me looking at. Again, what I'm doing here is trying to get an understanding of what sectors are behaving as the broad market, and that's giving me an overall clear picture of what's going on, right? And I do this every evening. I just click through all of these. It's called a waveform comparison analysis. It takes me all of about 5 minutes to click through all the sectors, and I have a little notepad by my tablet or by my computer where I keep track of the things that I should be paying attention to, because I'm looking for anything that's out of the ordinary, because anything out of the ordinary is an opportunity for profit. Write that down. Anything out of the ordinary is always an opportunity for profit. From an option standpoint as well, it is important to also look at how the VIX is doing. What's our implied volatility doing? Because implied volatilities are something that we can profit on as well. As you can see, the implied volatility over the last month has been getting stronger. Has been getting less and less. And then all of a sudden, in the last couple of days, the S&P 500 dropping just a little bit, but the implied volatility has jumped to the ceiling. Again, those are tradable opportunities, things that we want to pick up on. Once I have an overall picture about what the broad market is doing, I can then look at individual symbols and have an idea as to what sort of trading strategies work there. They fall into 3 categories, as I mentioned earlier. Whether we want to be doing directional trading, that means If the underlying symbol is moving, changing price, our option strategy will profit on that movement of the underlying symbol. If I want to be selling theta decay optimized premium, that's based on profiting on the fact that the option is a wasting asset. And the only thing that can work against a theta decay optimized premium selling is an abrupt directional move in the underlying symbol. So if we see something that's going sideways and it's been in a horizontal channel for a while, we want to sell premium against it. Because as it just kind of putters along, not giving us any directional opportunities, we could be making money on time passing by. And of course, you want to go the next level, we can look at when there are increases and decreases, usually around some sort of scheduled events in implied volatilities, and we can buy and sell premium that is optimized for changes in implied volatility. Here's the scoop, the beauty of option trading. With stock trading or commodity trading, we can only profit when the price of the stock or the commodity goes up or goes down. We only have two ways to profit when that's all we're limiting ourselves to trading. When it comes to option strategies, we have 27 different option trading strategies that we can apply to any combination of movements. So with a stock, you're either going to make money by going long, meaning you buy low and try to sell high, or by shorting it. You're going to sell it high and then buy it back low and keep the spread. With an option strategy, I can make money on whether the underlying symbol is going up, whether the underlying symbol is going down, whether the underlying symbol is going sideways. I can make money on time passing by. I can make money on people's fears increasing. I can make money on people's fears decreasing, and any combination. There's 27 different ways to profit. And the key is just understanding what you're seeing. The pattern recognition is what you're seeing, and then applying it there. So right now we're having something what I call a transient external stochastic shock. That might be a term you've never heard before. In fact, I've never really heard anybody say it besides me. But it's when the market reacts emotionally to something external to the market. I treat these moments differently than I treat things that are supply and demand driven. For the most part, the market has been going sideways. In fact, the market has been going sideways since the end of what we call the Trump rally at the end of 2016, 2017, for all of 2018 and into 2019. We're about 8 months into 2019. We've been going in a sideways choppy pattern. So in that case, there are opportunities depending on how active you want to be for trading very nimbly if you're an active trader, for some directional trading. For those of you that excel on premium selling, especially theta decay optimized premium selling, we've been killing it in selling premium for the last almost 24 months. If you're trying to trade long-term directional strategies where you buy and hold for a while, you're probably coming up empty. And then the implied volatility changes have been more extreme than usual. So if you're a volatility trader, you've probably got some great opportunities. For the most part, the market is benefiting those that are trading sideways choppy strategies. But always understand your broad market, understand the sectors, understand the candidates within those sectors, and you're not going to understand them by doing a single broad market analysis. You're going to have to start taking notes on what you see and comparing that over time. Is the market in a state of distribution? Is a particular sector in a state of distribution? Or is it in states of accumulation? Or is it springboarding? Is it getting ready to move from one state to the next? Those are things that you'd want to identify. Which brings me to a point. Somebody was asking, in fact, we got quite a few of the questions asking, why don't you focus on indexes and ETFs? Why are you predominantly trading underlying symbols that are stocks? That's a great question. We had that question appear about 5 or 6 times. A index or an ETF is a combination of stocks. And there's been a proliferation of ETFs and indexes over the years, which has led to a phenomenon called correlation. Correlation has gotten stronger and stronger over the years. Correlation is where an underlying symbol that may be fundamentally doing well, meaning a company is doing phenomenal, its stock price might get clobbered because the ETF that is trading its stock got sold off. So for instance, take for instance the transportation ETF. There's many ETFs that trade like the transportation index. FedEx is doing well, UPS is doing well, DHL decides to take a dump. Because ETFs are not managed by a market manager, a mutual fund, pension fund, whatever kind of manager, they are simply mathematical calculations. They're baskets of these stocks. When DHL takes a dump, the ETF takes a dump, and it winds up bringing all the other companies contained within that ETF down. When you look at the amount of shares of ETFs that are traded, it has become eclipsing to the actual individual stock shares. Now, you think about why people trade an ETF, and they're hedging on something like the overall broad market. They're hedging on things like a sector. They're making bets, if you will. There's no fundamentals that you can analyze to even give you a hint as to how that ETF is going to do. There's no soft data like, will this stock split? Will this stock give its earnings? And so because of that, there's no way to basically analyze the backbone of the ETF. You're basically making an investment on hearsay or whatever news headlines are affecting that particular index or sector. I like to be able to understand what events are coming up in the history for a particular stock, what the fundamentals are, what the soft data is, who's in charge of the company. And so that's why I always recommend going with the stocks. You can do more research on a stock and take into consideration the corollary effects, the correlation effects. But with a stock, it does have a certain amount of independence that is still driven by company success or company failure. The next question is people have been asking, what sort of strategy should I use on a small account? All right. Whether you have a small account or a large account, the option trading strategy you decide to use is not account size specific. I'll say that again. The size of your trading account does not specify or is not directly related to what option strategies to trade. Whatever option trading strategy you trade, you always set what we call a risk stop. Let's write that term down. No matter what option trading strategy you trade, you always set something called a risk stop. Another name for a risk stop is a bailout. On a directional strategy, this may have something to do with an underlying symbol price. With a theta decay strategy, it may also have to do with a underlying symbol price, but in a different way than in a directional strategy, related differently. Implied volatility trade, it may be an implied volatility value. But you always set a risk stop or a bailout. And once you've set that risk stop and bailout, and let's take a moment and talk about how to set a risk stop or bailout. You should look at the behavior of the position. And you should allow for movement against you within reason, because the underlying symbol or the market doesn't go in straight lines. It jitters all around. So you allow a healthy amount of up and down action in whatever variable you're measuring. And you basically want to set a criteria, a risk stop or a bailout, such that you will get knocked out if something unusual is happening, if the proverbial poop has hit the fan. Something that hasn't happened in a while, something that is well off the charts. Once you've set this risk stop or bailout criteria, the next step is to evaluate what's the worst amount of loss that you might incur if that risk stop or bailout is triggered. What's the worst case? So calculate that worst case loss. And from that loss, that's called your max risk? How much risk per share will you be exposing yourself to? So say, for instance, we have a directional strategy and we're going to set a risk stop we'll set a risk stop at 3% below a normal stock price movement. So our risk stop, if the underlying symbol is trading at $100, we'll set our risk stop if the underlying symbol dips below $97. We're going to get out of there. We're going to liquidate our position and get into all cash and take our hand across our brow and say, phew, we got out with this expected amount of loss. Now, if we're trading a stock replacement strategy, that 3% move in the underlying symbol could easily turn into a 20% move in a leveraged call or put. Again, I'm just throwing an example out there out of the air. You'll actually want to, for the position you're thinking about getting into, you'll want to determine the actual loss that you could be exposing yourself to. So say, for instance, we exposed ourselves to 20% loss. Now you have to decide how much of your portfolio you can put into that trade. Here at Trading Trainer, I recommend that the max you ever expose your portfolio to for any one given trade is 4%. 4% means that if your trades go horribly wrong, remember we set that bailout, that risk stop, for horribly wrong situations. If your trades are going horribly wrong and you're getting bailed out, you're getting cashed out at the max loss, the worst case scenarios, if you only expose your portfolio to 4% loss on each trade, you would have to go horribly wrong 25 times in a row to wipe yourself out. Does that make sense? How many of the show of hands does that make sense? 25 times in a row. Here at Trading Trainer, if you have 3 of your positions go horribly wrong in a row, I tell my program participants to cash out your portfolio, stop what you're doing, and analyze how you're doing your investing. Because if 3 of them go horribly wrong in a row, it's not the market giving you a weird pitch. It's you. You've done something wrong. You're doing something wrong. It's your trading program. It's whatever you're doing, your pattern recognition, your pattern utilization. Something's wrong because you should not be being bailed out at max risk 3 times in a row. So that means that in the worst case scenario, you'd stop what you're doing, you'd reanalyze things with a 12% loss to your portfolio. I've heard situations where people have lost all of their portfolio or 50% of your portfolio on a single trade. This is keeping you from doing that. So 4% is the max, but I also, based on the size of your portfolio, would pare that back. So if your portfolio is from $0 to $5,000, I would set my max allowable risk per trade at 4%. If your portfolio is 5% to 25%, $5,000 to $25,000, I would drop that from 4% to 3%. If your portfolio is from $25,000 to $250,000, I would drop your risk per trade to 2%. And finally, if your portfolio is over $250,000, I would drop your risk exposure to 1%. So let's say we have a small portfolio of $5,000. That means our max allowable risk to our portfolio is 4%. The position size, in other words, the percentage of your portfolio that you would risk or that you would invest in this particular trade, is equal to whatever that max allowable risk per trade is divided by the worst case scenario risk from the trade. So I'm going to bring over a calculator, and if we have 4% and we divide that by 20%, that's telling us that we can put 20% of our portfolio into that trade. If our portfolio is $5,000, we can put $1,000 into that trade. Now, if the trade per share is, I don't know, let's make up a number, $20, we can buy 50 shares. Now, option contracts come in lots of 100. Would I be able to buy any option contracts if I can only afford 50 shares? The answer is no. So this tells me that my portfolio is too small to do this transaction. This is important to come to before you actually sit down to trade this transaction. This is called managing your risk. Successful traders focus on planning. They plan their trade based on the pattern that they recognize. They use an option trading strategy to utilize whatever pattern they're recognizing. And when they're doing this planning, they always plan out how much of their portfolio they will invest. They always plan with risk management in mind. Traders that I have found that have not seen consistent success, one of the first things that I've noticed is that they will focus on how much reward potential is in a trade. We don't calculate our rewards until the position is closed. In planning, we manage our risk. And what I've shown you this evening is how to manage risk. When you look at a successful trader's focus, what you'll find is that about 40% of their focus is on managing risk. And then you might say, well, AJ, what's the other 60%? Well, 50% of it is managing their trading emotions. How to make sure they don't react if it's not in their plan. And then you say, well, what about the last 10%? Well, the last 10% that I have found that successful traders focus on is the actual trading strategy that they're deploying. interesting, but that is the statistics I've come up with. All right, let's see if we can get one last question in during the what is the best strategy with the highest win rate? That is the next question on the list that people have asked. And the one after that is, with markets being uncertain and the slowdown of the economy, how do you not lose money? Actually, that question is answered by risk management and also answered by the first part of this call, which is applying the correct strategy. So if the market is going sideways and is uncertain, there is a strategy that profits on markets being uncertain, right? So just realize you have to fit the right tool to the situation, and you have to size the tool based on risk and not based on reward. What is the best strategy with the highest win rate? Again, I come back to the topic of the first questions. That is going to depend on the pattern that you recognize. So a strategy works if you fit it to the situation. So for instance, if we have a pattern that is consolidating, getting ready to move, and we see the consolidation and the implied volatility is low, then the strategy we want to deploy is called a straddle or strangle, or we could use a straddle-strangle hybrid. A straddle or strangle will be the best strategy with the highest win rate for that scenario, where implied volatility is low and price is consolidating ahead of an event. What about if price is consolidating and implied volatility is high? The best strategy in that case is your double calendar spread, specifically set. And you can use analyses like bell curve analyses to help you decide where to set each one of the double calendar spreads. So there is no one silver bullet. I wish it could be that easy, but it's more a matter of matching the correct option trading strategy to the correct price pattern. And so that is one of the pet peeves I have around other programs. I have seen many programs over the years. You know that Trading Trainer's been just about, we're coming up on close to 20 years of being an existence, teaching people how to trade stocks and options. Some of the other programs I've seen over the years is focused on a particular option trading strategy, such as, hey, learn everything there is to vertical credit spreads. They will be the panacea. They will be the answer to your problems. And that's just a sure sign of getting in trouble. I've also had folks come up to me and say, can you teach me how to trade covered calls? I've heard covered calls are the best strategy to use out there. And I always say, well, I can teach you how to sell premium. Covered calls could be one of the strategies, but I could teach you how to sell premium, and I can tell you how to make sure that the underlying symbol pattern is optimized. Only pick those underlying symbols that are good for trading premium. And I'll actually have folks get upset with me because all they want to do is learn how to trade covered calls. I'll often ask, well, what if the pattern of the underlying symbol isn't best for trading covered calls. I had one gentleman, I just remember this was about 5 or 6 years ago, who got really upset with me because I wouldn't promise to train him on just covered calls. And I always run into a moral dilemma because I can train somebody, I could do exactly as they request, but I actually opted out and said I'm not the right teacher for you because I know that if I teach you how to trade covered calls only, you won't be prepared for success. We have about 4 minutes left. I promised my marketing team that we would keep these calls exactly at 1 hour. The last question, I'm just looking at our software. As I told you earlier, our software went through and took all 198 questions and looked for commonalities. Where can I learn? This is the 5th question down. Where can I learn to research and trade options on my own so I can become my own boss and live life on my own terms? Okay, that's a great question. Let's finish there. You're not going to learn it by reading a book. You're also going to have to understand that trading stocks, trading options, this is something that we call investing. Investing is different than being an employee, which is where somebody pays us to do something. Being self-employed, where we somehow get paid for doing something. We're usually the person who gets paid on getting the something done rather than getting paid for doing something and, trading our time. Self-employed people tend to get paid by the project. There's business owners out there, often confused with self-employed people. Business owners know how to manage costs and resources, where what they have in expenses are less than what they earn on incomes. So they're managing basically human and material resources. That's a business owner. And then there's the investor. The investor has figured out how to make money from their money. So the rules that apply to being an employee, which is showing up when the boss tells you to show up and leaving when the boss tells you to leave, don't apply to being an investor. The rules that are for self-employed or even business owners do not apply to being an investor. You could show up at a certain time every day and leave at a certain time every day, and you wouldn't make money, because the rules of being an employee are not the same as the rules of being an investor. And that's a hard thing for people who have been an employee or even a business owner or a self-employed person to change gears like that, to understand that it is a function of the amount of money you're working with. It's a function of understanding how to manage risk, how to manage your emotions, and it's a function of deploying the correct strategy under the correct circumstances. Investing is a game of chess. It's not a job. So that's the first thing. The second thing is it's a skill. You can't learn a skill in a book. They don't allow you to read a book, pass a test, and be allowed to fly a plane. You have to practice and work out all the bugs over practice and practice and practice, and you have to demonstrate that you can actually fly a plane before they'll give you a license to fly a plane. You cannot read a book to become an athlete. You must practice your sport, gain experience in it. You cannot read a book and become a chess player. You have to practice. Playing chess is a skill. Investing is a skill. Trading options is a skill. My suggestion to you is to practice with a paper account. Learn a strategy. Learn what patterns you're supposed to be recognizing, and what option strategy you're supposed to be using, and then practice it. Practice it over and over until you get good at it. Build that skill. Whenever you're building a skill, whether it's flying a plane, learning a sport, learning to play chess, you can do it through trial and error. You can learn it on your own just by trying it. And if it doesn't work, try it again. And if it doesn't work, try it again. Or you can learn it by the next best method. By the way, if you learn anything by trial and error, that has been proven to be the way to learn something the best, is through trial and error. The problem is learning something through trial and error takes a hell of a long time to do, and the error part can be somewhat painful. So the next best way to learn something is through guided discovery. This is otherwise known as following in the footsteps of somebody who does it already. So I would recommend that you apprentice or you follow in somebody's footsteps who has already done it, and let them guide you. But you're still going to have to practice. You're going to have to put in the practice time. There's no magical pill or switch that somebody can switch on their control panel that will change you from being somebody who knows nothing about trading options or investing to someone who does. The beauty part of trading stocks and options is that we can trade them in paper and practice our strategies and build the experience without ever having to lose real money. So that's what I suggest you do. I suggest you find somebody who knows what to do, meaning they have had success. You follow in their footsteps, and then you practice over and over again until you're ready for prime time. And that is the end of our time together. We answered the top 5 questions that came in out of the 198 that were asked. We'll provide a replay of this webinar to all of you. And I know that quite a few of you have asked for the transcript. So for those of you that bought the transcript, we will have that for you in the next 48 hours. And best of all, we'll come back in about a month and do another one of these. So if your question didn't get answered tonight, please, when we send out emails for the next month call, ask it again. Or maybe you'll have new questions to ask. Put a question in there and allow our software to determine again the top questions. I promise I won't answer the same questions twice. So we'll just keep going down the list. Again, this is my public service to the trading community to bestow my experiences and get your most hot burning questions answered. Ask AJ. All right, let me ask this question of those of you that are on the call. How many of you, with a show of hands, picked up something new this evening you had never heard before, you never knew before? Excellent, excellent. How many of you, with a show of hands, picked up something this evening, new or not, but now you have a much better idea how to wrap your head around it? Excellent, excellent. And last but not least, how many of you, with a show of hands, enjoyed yourself this evening? That's all I've got. I hope you have a good rest of your evening. Please take care.